Hey everybody, in today's video we are going to be going into the CoveredCall ETF ALLSTAR tracker today. This is something that I've built out. If you didn't watch my previous launch video, this is something I've built out, something that will be in many videos coming forth, just because it was something I wasn't finding a lot of info online that I was particularly happy with. So decided just to develop something that can take the information you would find on, say, Google or Yahoo Finance and merge it with info you would find on a lot of the fund manager websites. So what we're going to do today is we're actually going to use that tool. I'm going to show you guys kind of how to use it in a real life example. Now we're going to be taking a look at all-in-one funds and compare the performance of all-in-one funds versus sector CoveredCall ETF. So if you're someone who's maybe wanting to build out or has questions about building out a portfolio around all-in-one funds, so these are CoveredCalls that invest in other CoveredCall ETFs, we'll focus on that. Or maybe you are in a different camp and you're thinking, maybe I actually want to build out a portfolio of sector-based funds that I can kind of pick and choose. So we're going to go through those two scenarios of what that actually looks like using the CoveredCall ETF ALLSTAR tracker. Now, if you're interested in using this for yourself, it is available to use. You can head over to my main YouTube page, and if you click up here on the main page, it's also going to be in the comments, and it'll be a pinned comment for this video and in the description below. It'll basically take you to Patreon here. It's about $9 USD. I can't figure out for the life of me why it won't show up in Canadian dollars, but anyway, for now this is $9 USD, which works out to about $13 Canadian. So it'll get you access to this month's tracker and next month's tracker as well, which I'm going to be updating every month. Big updates, newer funds, much more information month by month as we go on and as this becomes a much more powerful tool. So with that being said, let's actually use the tracker and show you guys kind of what it looks like, what it would look like for you guys to actually use it yourself. So you know what I'll do for the moment. I got these two windows open. They're in view only mode. So this is what you guys would see. So right now we can't actually apply a filter. Well, you can see that as I click on what looks like to be filters, it's actually not showing up. So this is something you got to apply on your own, which if you miss it here, I do have a little short video on Patreon of how to apply a filter. So what we're going to want to do is click on number 2, vertical column there. Click on row number 2. We want to go up to data, and we want to create a new temporary filter view. And so we've just done that. I'm going to do the same thing over here. Click on number 2, column 2, go up to data, filter views, and create a new filter view. So now when I hover over top, I will be able to filter it. Okay, so we'll go back over here. So the reason, again, why I have two windows, because in one window, we're gonna filter out the all-in-one funds, and the other one, we're gonna use sector-based funds. So with that, let's go over here to the first tab, and we're gonna go to fund category. So fund category is just basically it's sectors. This is again something I'm probably gonna separate in time and have two columns instead of one for, say, sector, and the other one for, say, geography, like where it's mostly located. But anyway, for now it's kind of just it's kind of in one umbrella term with fund category. So what we're going to want to do is click clear, and we're just going to click on all-in-ones. We'll hit OK, and that'll filter out all the all-in-one funds, ETFs that invest in other ETFs. So for example, if you're not familiar, ZWQT invests in a bunch of BMO funds, like their own funds. Brompton, they invest in their own funds. HDIV and HYLD, even though these are by Hamilton, they are looking to invest. Hamilton is building out their own suite of ETFs, their maximizer suite. that they're continually to put into these two ETFs. But for the moment, they do invest in other ETFs by fund managers, but they are looking at changing that to be more in-house. Okay, HDIF, again, Harvest, they invest in their own CoveredCall ETFs. And EQCL, no different. It invests in its own ETFs as well. So these are the 6 all-in-one funds we're going to be looking at, and we'll compare it against, let's call it 6 sector funds. So for this example, instead of going over to fund category, I'm just going to pick out a bunch of random, I wouldn't say random, let's go, I'm going to go ENCL. Let's actually populate that with some more. Let's go bank. Let's also go HH. I want to try to put as many different sector funds in here, something that'll capture everything. So we'll have utilities, we'll have tech, we'll have financials, we'll have HPYT. Let's do bonds. Let's see what that looks like. I think so. These are the 6 funds that just ahead of time I kind of picked out, mainly because I thought just for the yield focus, because as an income investor, let's be real, you're going to be highly focused on yield as well. So now that we've picked out our 6 funds, we got Bank by Evolve. They're focused on financials, the big 6 Canadian banks. UMAX is focused on, say, railways and communication, pipelines, and again, other utility driven companies. HHL, they are again, it's a leverage version of healthcare. HPYT, so that's going to be your bonds. ENCL, energy, leverage version, and QQCL is going to cover technology. So I think we got a decent mix of some of the more some of the bigger sectors that are out there, the more important sectors out there, of course, to industry, civilization. Let's start with, we won't do trailing yield, but we'll do forward yield. That's why I made it in bold and I didn't make 12-month trailing yield, just because some of these funds haven't been around for 12 months. But the forward yield, let's look at that. If you were to build out a strategy based on, say, if yield is a big factor in that, one thing we can do is just down in the corner here, if you kind of highlight, if you were to highlight a bunch of these funds, you can go down to sum here and change it over to average, and then we can actually just, instead of clicking on it, we can actually see what the average yield would be. So for the all-in-one funds, we're looking at an average yield of 10.10%. If we do the exact same thing with the sector-based portfolio, we're looking at, let's change that over to average yield. You're looking at an average yield of 14.85%. Now, for context, in my own strategy, I actually use both. It's probably roughly 60% all-in-ones or index-based CoveredCall ETFs, and then another 40% based on sectors. Why? Because I see sectors as yield boosters. And that's quite telling if you were to compare the two. The sector-based portfolio is almost, well, what is that? Like almost a full 5% ahead as far as yield. So, I mean, for a lot of people, that's going to be quite powerful and motivating to see that. Again, if you're wondering like what forward yield is, there's the equation there. If you get the tracker, there are all these notes kind of littered throughout the tracker just to help explain what everything is. So for forward yield, you obviously got current distribution times 12 months divided by the current share price, and that's how we get this yield. Okay, so let's move along maybe to daily volume. Let's just see how liquid some of these funds actually are. So if we're looking at ZWQT, that's pretty low in my opinion. Anything that trades under 1,000 is, especially on the Canadian market, very tiny. But again, this info is based off of it was extracted from December 29th, right? So it's not necessarily, when you're looking at this, it's not updated on a day-to-day basis. It's just info from the last trading day of the month, so December 29th. Let's take a sum and see what the average is. So we got average trading daily volume of just under 25,000 units. Let's go over to the sector and see what that is. So slightly lower. The all-in-ones are definitely a lot more, I would say, certainly a lot, and from that perspective, a little bit more liquid. I'm still okay with, say, that sort of trading volume, even on an individual level, 10,000, 25,000, and then even HPYT, like great trading volume, very liquid. But all these I'm pretty okay with. It's just once you start dipping down into the hundreds, that could potentially be a problem. Like I do know of someone who bought something a couple years ago, something that wasn't very liquid, was trading, maybe in a similar range. You can see that the 3-month average volume is not 100. This was just from one day, but the average every day for 3 months is about this. But for an example, if you were to buy something where maybe the average 3 months is 100, you could potentially end up paying more because it's just not as liquid. So that's certainly just a concern I have. Taking up a new position, definitely look at the volume. And when you go into, say, Wealthsimple or Questrade and you click, buy, and usually there's an order preview, and it should show you like how much it's actually going to cost. So just definitely take a look at that preview before you actually hit execute. Would be a good tip off for you guys. Okay, so 3-month average trading volume. Let's look at that. Let's see if it's any different. We're looking at the sector mix. So a lot higher versus that one day. So the daily volume from December 29th, we had just a hair under 17,000, but the average trading volume is much higher. So well over double at 42,288 units. Let's go over to the all-in-ones. Let's see if it's more liquid. So in over a 3-month term, daily, the sector funds are more liquid over that period of time versus that one day trading volume on December 29th. Okay, so now that we've looked at that, let's kind of move ahead. A lot of this performance, 52-week low, 52-week high, I'm not going to really be looking at that, but let's maybe look at 1 month performance. If you had all of these all-in-ones, all in one space, what would your average price performance be? Well, let's check that out. So you're looking at about 2.06% over the past, that's 6 months. Let's do 1 month. So 3.41% for 1 month. Let's check out the sector portfolio, and how would that have done over the course of 1 month? We're looking at 2.52% versus 3.41%. So the all-in-ones slightly out ahead as far as price performance for 1 month, but let's now do 6-month price performance. So at 6 months for the all-in-one funds, you're looking at 2.06%. And for, some of these sector funds haven't been around for all that long, so that might be an unfair comparison, right? So HPYT, ENCL, QQCL, their inception dates were in the back half of 2023. And anyway, so haven't been around for that long. And whereas the all-in-ones have been around for a little bit longer, let's look at, say, 1 year price performance. You're looking at about 2.81%. So, I mean, for me personally, I know a lot of you all know that I'm trying to construct a portfolio that does have a little bit of, as best I can, price stability, price performance stability, along with a little bit of growth over time. So that it definitely plays a big part into my equation as far as my strategy is concerned. So anyway, now that we've looked at just kind of historical performance, there's obviously nothing we can really talk about in the 3 to 5 year range as Most of these funds just have not been around for that long. There are certainly covered call ETFs that have been around for that long, but I just think the older ones are just not necessarily as efficient as these newer ones have come out. And I think that's something that we are continually discovering over time, is that, yeah, the older funds, not as efficient, newer funds, definitely much more efficient. But we'll just, as long as this tracker continues to develop month over month, we'll see that performance play out. All right, so now we're kind of getting into more info you would find on, say, the fund manager websites. So let's start with maybe, let's just do, here, we'll start at ex-dividend dates. Payout date, so I obviously included that because you guys got to know when you're getting paid out. Where again, with that all-in-one fund portfolio right now, everything pays out monthly. The sector portfolio, everything pays out monthly. Let's look at management fees. So average management fee is about, let's see, it says 0.45%. One thing to note with the underlying funds, if you're not aware of, like, yes, it says 0, but usually it's because the underlying ETFs that are inside these all-in-one funds, usually they have about, they have their own management fees, so they're not going to double dip. So for BMAX, a lot of their underlying ETFs are about 0.75, and HDIV, it's a bit of a mixed bag, anywhere from 0.65 to 0.85, depending on what the fund is. So maybe this might be a little bit hard to compare. One thing we can definitely do is look at MER. So the MER is, for those, again, who don't know, MER is simply all the operating costs. So that would include management fee, trading costs, and leverage expenses if there is leverage. Now, most of these funds do have leverage. EQCL leverage, HDIV, HYLD, HDIV, and BMAX all have 25% leverage, which we're going to see in a column that's kind of to the side of us. Whereas if we go over to the sector-based funds, we can see the average management fee is 0.057. HHLE, it says 0 management fee. That's because it's underlying fund. Its underlying fund, HHL, probably has, again, maybe 0.65 to 0.8 or 0.85, somewhere in there, but you can see its MER is 2.5. From the all-in-one or the sector portfolio to the all-in-one portfolio. What I might do in the future is actually just put in a management fee here, or the average management fee, just so it's a little bit more so you can understand it's not just simply 0%. That's obviously not the case. It's just the underlying ETFs that it holds have the management fees. So it's basically, it would be an average of those fees. Okay, moving along, I've also included portfolio coverage into this as well. So you can see with the all-in-ones, we have HDIV, HYLD. I said it's various just because a lot of their underlying funds have so many different strategies. They're from different fund managers. Again, pretty hard to pinpoint what the average portfolio coverage is for that. But everything else, like ZWQ, basically everything else, they hold their own in-house ETFs for underlying assets. So with BMAX, obviously, with their underlying funds, they are probably the most liberal when it comes to this. They go up to 100% coverage if they really want to achieve consistent returns. ZWQT, BMO's known to go 50% coverage. Harvest, again, they usually do 33%. And then Horizons is typically 50%. So if we get an average, well, it probably won't show us the average just because we have these two things in here as well. Yeah, so we'll move along over to the portfolio sectors. This might give us a better understanding of what the average coverage is. It won't do that, again, because I've included the words up to. So again, that might be something I get rid of just so that you can so you're able to get an average over the course of time. Okay, let's move along to Moneyness. So again, it's just another measure of how aggressive it is to achieve these premiums. BMO, they're usually like well out of the money, but their yields are also a lot lower, definitely under 10% for the most part, in this maybe 6 to 7% range. BMAX, again, with their portfolio coverage up to 100%, they could be out in the money. It basically, again, the most liberal, whatever it takes to achieve their consistent returns. Harvest, again, a little bit flexible at or out of the money. And Horizons, typically 50% coverage out of the money. Okay, now we're moving on to AUM. What are we looking at for average AUM? So we can see a total AUM of $500 million, and average AUM is 85 million. And that's for the sector-based portfolio, whereas for the all-in-ones, we're looking at 1,280 million. So their AUM, obviously, with the all-in-ones, are very popular. A lot more money flowing into the all-in-one funds, just because they are very well diversified, and that's what people like. They like the convenience of it being diversified. You're getting more funds in one spot. Even if certain funds invest in other fund managers like HDIV, HYLD, again, these fund managers, they're working on building out more of their own in-house products. But for Harvest and Horizons, for BMO and for Brompton, they already have that. They already have their in-house funds already put into these all-in-one CoveredCall ETFs. So in my mind, no surprise there. The total AUM of these six versus these six is more than double, simply for the diversification reasons. So you just simply get more funds. Okay, now we're moving on to leverage. So with the all-in-one funds, you can see that leverage is a big part of it. Most of it is 25%. The only outlier being BMAX at 33%. So again, with leverage, this can amplify price performance, but it will also magnify yield as well. So for the most part, other than ZWQT, all these other all-in-one funds have leverage. And for a little over half of the sector funds also include leverage as well. Price performance a little bit higher and pushing up yield a little bit higher. The only two being UMAX and HPYT. UMAX is part of this maximizer suite of CoveredCall ETFs that are sector based. I know I think they got American Financials coming out, or US banks. Healthcare's on the way. They have an energy one coming out. Currently they have a utilities one. They have HMAX, which is a bank one. HBond, which is their US bonds one. They have SMAX and QMAX more or less to represent the S&P 500, QMAX to represent the NASDAQ 100. So with that being said, again, more leverage used on these funds. Let's look at dividend streaks. We can see with the all-in-ones, the highest dividend streak we have so far is HDIV. I don't think it has not cut a distribution. It's been only growing over time. Same with HDIV. I believe it's been consistent all the way. I don't think it's actually necessarily grown, but it's been the exact same over this entire time. BMAX, same thing as well. It's been the exact same since inception in late 2022. ZWQT, I believe it's been the same, no drop. EQCL has only been around for a couple months. So, and even HYLD, it had that drop back in, I want to say it was April of 2023. So ever since then, it's been steady. And as of January of 2024 here, it's raised its distribution. So for the most part, the all-in-ones have been pretty steady. Let's check out the sector funds. Bank, obviously being the biggest one out of all of these. This one has been a grower over the last 2 years. HH, dividend streak. Its underlying has done phenomenal. I think it's one of the biggest dividend streaks. HHL. HHLE, being the leverage version of that fund, hasn't been around as long, but it's going to basically perform in lockstep with its underlying ETF, HHL. And then UMAX, ever since its inception in July of 2023, it's kind of been just slowly going down distribution-wise. I want to say, as we get over here, its distribution has declined a little bit, so incrementally, which is something we're going to see over here. Since July, it's gone down 1.72%. And everything else is so new that these dividend streaks are kind of don't really matter as much right now. We'll see in a year from now how HPYT, that bonds sector ETF, performs, as well as ENCL and QQCL. I want to say the underlying of ENCL probably has been paying out a consistent distribution since late 2022, probably in the last month. So its underlying probably used to be a lot more variable, but ever since, I think, November, December 2022, it's been pretty rock solid since then. Same with, I believe, QQCC, the underlying version of QQCL, also has been pretty stable over that period of time as well. I think ever since late 2022, Horizons, I think, went from variable distributions to more stable. Okay, so the last section we're going to look at here, probably one of my favorite sections when it comes to this tracker, is just how have these distributions been growing over time. So when you look at this, like this column here, so December to January, you can see that this column under AK, you can see that this is where I capture any changes in distribution. So for the most part, we have 4 funds that have stayed the exact same, with 2 funds being HDIV and HYLD have grown a little bit. We can see that HDIV has gone from 14 cents to 14.1 cents, and HYLD going from 12 cents to 12.1 cents. So marginal gain, but hey, anytime that we can see any kind of natural growth within these covered call ETFs, to me, it's more of a bonus than it is an expectation. Love to see it. Hopefully it continues, and I think into 2024, funds like HYLD certainly will grow more, especially if interest rates go down, as they add in more of their own in-house products, then it just simply means less fees are getting paid out to those third-party fund managers. So, and then we have this column right here. So under AL, this would be a combination of AH and AJ right here. So the very first distribution that ever came out with any of these funds, and the very latest distribution. So we can see, for the most part, there has been zero growth from ZWQT and BMAX. Again, these are funds that are relatively new. They're under a year and a half old. HDIV and EQCL, again, only a couple months old. HDIF, late 2022 it came out, so no growth there. But what's more impressive has been HDIV. I think this came out in early 2021, so over the course of almost 3 years, it's grown its distribution by 20% on average. Call that, what is that? Almost 6.5%, something like that. Almost 7% over the course of 3 years. HYLD saw that massive distribution cut in April of 2023. So it's slowly going to be most likely working up its way back to still a great, working its way back up to that 14 cent mark that it used to pay out at. Still, in my opinion, still a really good fund. I really like HYLD. Okay, so we've looked at those changes. Let's look at some of the sector-based changes. Okay, so we see that again. We see month over month, things like QQCL, ENCL, HPYT, and HHLE have not grown month over month. A slight distribution cut month over month from December to January. of 0.29% from UMAX. Then we have the biggest grower month over month, which is Bank, going from, what would that be? 9.3 cents to 10 cents, a month over month change of 7.53%. Let's see and then Bank, its first distribution was paid out in February of 2023. So this fund, Bank, is not even a year old, but over the course of a year, it's had this amazing run of increasing its distribution by 42.86%, which is absolutely phenomenal for a covered call ETF. Let's hope it stays that way and is able to pay out that same amount. So again, when we look at sort of the changes, as an example of looking at all-in-one funds versus sector funds, this is again something you can play around with this tool. I encourage you guys to try it out. Again, it's $13. In my opinion, it's not going to break the bank. You'll get this month's tracker plus you'll have exposure to next month's tracker as well. You'll be able to see the changes month over month. The kinds of big updates I'm planning. Again, I'm working on it currently where I'm going to be adding in all the .U, .B funds. So these are other Canadian covered call ETFs. There's probably something like another 25 funds I'll be adding in February, which include, US dollar versions of some of these funds and the Canadian hedged versions of, again, all of these funds. So some of these funds, for those who aren't aware, have like 3 different versions of the exact same thing. So that will come in February. And then I'm also looking at adding in February as well distribution history of all of these Canadian funds. And then again for March, for the March update, I'll be including as many American covered call ETFs as well. So with all that being said, if you like what you saw, hit all the buttons of like and subscribe variety, and hopefully you guys try out the tracker. I think it's going to be a really powerful tool for you guys, and we'll see you all in the next video.